In this video, we're going to look at profit target ideas for swing traders. Stay tuned. Hey traders, a very warm welcome to you. Okay, so this one is for you swing traders out there. Some different ideas for you to create your profit targets. Now, you may well have a profit target already that's, hey, it's the defined level I want to see that price get to. It's the high, it's this, it's that. But sometimes you're kind of looking at a trade and you're going, well, where exactly should I have my profit target? Or where should I kind of scale out of a position? Where should I at least consider this thing could go? Sometimes it's not that obvious. Sometimes the risk reward ratio looks quite good and you kind of look and say, hey, some blue sky there, or we can backfill quite a lot, but where's it going to go? Okay, so here's some ideas for you. Especially when you're into fresh territory. You know, it's all very well if we're taking, I'll just draw this quickly, if we're taking something that's kind of done this and we've bought along and we say, well, actually, you know, we've gone long here, we can come out of that high. It's kind of easy because there's been some kind of price action beforehand that allows us to benchmark that and put it into perspective, and so that makes our life easier. So, but what about if we're in blue sky territory, or we're in the depths of beyond, if we're talking about a short trade? How do we then kind of decide where to go? Now, one thing I haven't put in here is fib extensions. You can use that as a structured way of kind of saying, hey, I expect it to go this much further than the low, whatever it may be. But, you know, that's not one of my favorite things. These are some of the things that I like to look at. Okay, the first one is channels. So what's a channel? So basically, if we're assuming we're kind of in, and okay, appreciate that I'm really oversimplifying this scenario, but let's say we're in a longer term channel here. One way we could do it is if we had that channel, that may not be as clean as that, and it probably won't be in the real world, but let's say we had bought here, even if we bought on a breakout, you know, we'd use the top of that channel as our kind of first target. So let's say we were, you know, long here, we bought it, and then we'd look to say, okay, I'm going to scale out, I'm going to use it as a target. We're just using the kind of width of the channel, and that hopefully the wider the better. Obviously, if it's a really wide channel, then our target's going to be way higher. But we're using kind of the previous volatility and previous rhythm and flow of the market to extrapolate out and say, well, actually, if that continues, that's really where I'm going to look at taking my profit. Or you might say, okay, you might not be strict about it and say, well, I'm definitely going to take my profit there. You might, as a swing trader, which is probably more likely, you might say, you know what, as we get to that upper channel, I'm going to extend that out with my drawing tool, whatever chart package I'm going to use. At that point, I'm going to reassess the trade. I'm going to look at the trade. I'm going to say, okay, we could be getting toppy here. Am I going to hold on for it? Can I sit through another rotation? Are we going to push on? Do I need to trim the position? How do I need to manage it? But that's a good place to kind of start looking at things if you don't really have a key level to look at. All right, next one is ATR. ATR is your average true range. And I'm a big fan of ATR. And if you've watched this in my videos before, I talk a lot about ATR in terms of using it for stops and using it for part of your trading strategy. It's a really useful tool. ATR stands for average true range, just giving us basically the range or the volatility, if you like, very simply put, of the instrument we're trading. And so, you know, we could perhaps say, hey, listen, I'm going to trade now. I feel like I've got a good entry. I feel like we could explode to the upside. I'm going to use, you know, 3 or maybe 5 times my daily ATR as a price target. Now, this is obviously going to depend on why you've bought the trade. If you've bought it because you feel like you've got the ebb and flow and you've got the kind of downturn of an uptrend and you feel like it's going to explode back up, you might only just be looking for one cycle, one rhythm of the market, one kind of chunk out of the move, in which case that's going to be lower. If you think, hey, you know what, I want to ride this for as much as possible, you might be looking for 10 ATRs. You might even go into a weekly chart and say, I want to use a week's worth of move. But the idea is you're kind of trying to quantify it relative to the volatility of the instrument you're trading. So this stops you from saying, hey, my target is $100 when you're sitting at, say, $10 and it's swinging a couple of dollars. It's going to put that in perspective. No, I'm not saying there's no problem having a target $100, but this kind of aligns you more with the rhythm of the market that you're trading if you're using an average true range to kind of give yourself an idea for a target. So, you know, in our example here, we could be kind of chugging along and we've bought it and we might say, okay, well, the ATR is $1, for example, on a daily. Our target would be 10 times 1, 10 plus our entry point. So if our entry was, you know, $30, then our exit or our review point is probably better, would be $40, and we'd wait for it to get there, and then we'd reassess or we'd take it out as we saw fit. All right, final one we've got for you is bands. So what do I just put bands on there? Because I think that, you know, Bollinger Bands are obviously the ones that get all the credit. Everyone talks about Bollinger Bands. Keltner channels are very, very similar. They're not actually called a band, they're called a channel, but they're very, very similar. And I've done a video on that before where I've talked about the difference between Bollinger Bands, which are based on standard deviation and kind of expand and contract, versus Keltner channels, which are actually based on average true range. I really like Keltner channels, and it's something that is worth looking at. But in terms of this video, we're talking about profit targets for our swing trades. Let's clear some of this off so we can get a bit more of a visual of what we're talking about. Bands are going to give us an idea of where price might start to stall. So if we have that scenario where price is, you know, moving along, and in fact I'll use a different color pen for this, let's go with the red. If we have, you know, our Bollinger Bands like moving with price as they kind of do, and these bands are the worst bands in the world, and you've got your kind of middle of your band, which is normally, if you've got a 20 period, it's a 20 period moving average. You may well say, hey, you know what, if I'm long and price starts to touch that upper Bollinger Band, I'm going to trim some of the position, because really, generally, price doesn't explode too much past that without backfilling, retracing. Sure, you might get multiple moves, but we're just talking about how to frame some ideas. And you might say, okay, well, if the price starts to kind of burst above the upper Bollinger Band or tag that upper Bolly, then I'm going to look to reduce the position. And actually, the bands won't look like that. A Keltner would look like that, but a Bollinger Band would generally go with the move, and it would expand. So that's not quite correct, but Keltner would jump right out. The price could possibly jump right out of a Keltner. The point is, when you're outside an upper band or below a lower band, it's generally price doesn't stay there for long. That's really a roundabout way of saying it. Yes, it can kind of continue and hug that upper Bollinger for a long time. Of course, you know, any of these strategies aren't going to, you know, they're not perfect, and maybe you say, hey, you've got some sort of criterion filter that allows you to hold that runaway trade. But these are just ideas that you can maybe put in and say, even if you don't use Bollinger Bands as part of your trading strategy to get into the trade, you might say, okay, well, actually, you know what, I'm going to use them because actually when it starts to tag it, it means we've moved multiple standard deviations away from a mean and arbitrary mean and moving average. That might be a time to kind of scale some out, let it retrace. And if you're using a scaling strategy, of course, you might scale some out there, let it unwind again, scale some out. Every time it's hitting that up in Bollinger, you're kind of scaling out into that stretch mode as opposed to waiting for it to come back on you. The traditional way is to, you know, kind of wait for the pull back and the break lower, and you come out here. This is slightly different because you're waiting for that stretch point to come out. Yes, you're not always going to get it, but it just changes the game a little bit, changes your kind of dynamic of the trade, and something to investigate, and maybe something to integrate as perhaps part of a specific trading strategy, especially if you're looking for that volatility expansion type trade, where you're trading it on the downswing and looking for that burst back up and a continuation and breakout type thing. All right, guys, some 3 ideas there for taking profits with your swing trades. Any more you've got, stick them in the comment section below. If you like this kind of thing, give it a thumbs up. Appreciate your view and your subscription. If you haven't subscribed, consider doing so. I shall see you in the next video. Take care. Keep the risk managed. Goodbye.